In Module 7.3, we cover essentially the same material as in Module 7.2. The only difference now is we're focusing on a credit spread introduced because corporate bonds might default. And so we're going to be focused on the additional risk that are encountered with corporate bonds. We'll model again, these risks with the additional LSC model curve. We could either model it as an additional spread or multiple spreads, and we'll illustrate with numerous graphs as well as go over some of the basic math. But fundamentally, this chapter follows very close, this module follows very closely the prior one. The central finance concepts will be decomposing holding period returns into the four now familiar components: the horizon, the spot rate, the spread, and the interaction. Within the spot rate and spread, we have modified duration, convexity, cross-convexity, and some estimation error, because if you recall, we're using a Taylor series approximation. And within each of these components of modified duration, convexity, and cross-convexity, we have level, slope, and curvatures. And we're going to show some graphical results. So the key figure in this particular module is the fact that we can take a bond holding period return, decompose it into horizon, spot rate, spread, and interaction. In this particular module, we're focused on the spread, which is a spread over the spot rate. And we'll be looking at decomposing it in a variety of different components. I want to remind you that the goal here is not additional layers of complexity for complexity's sake. If modified duration is adequate for what your needs are, just level, modified duration of the level, then stop there. But if you need a richer decomposition, then you might go with modified duration, level, and slope of both the spot rate and the spread curve. Because with corporate bonds, sometimes you have a spread event or a credit event, and other times you have an interest rate based event. And so this is the fundamental component piece. You want to layer on the level of complexity necessary to accomplish your task at hand and nothing more. The beauty of this particular approach is that we provide as much depth as you could possibly want. And so just to give a feel for how this is done, if you recall, we have a base curve, which is basically illustrated as this bottom line, both the curve itself as well as the discount rate for a zero coupon bond. And then there's actually the CMT itself. And then we have the double B rates. You can sort of see these X's are the actual observed double B rates. We have the fitted curve of those double B rates. And then we have the discount rates that we'll use for each component cash flow. And so the idea is we want to model a particular double B bond, and we're going to model it through a base curve and a spread, or just the double B curve itself. And so the three component pieces, we have the CMT yields, we have the double B yields, and then we have the implied spread, the difference between the CMT yields and the double B yields. And so all three of those components, given any two, you can create the third, and they're useful in a variety of different types of analysis. The ask yield to maturity, implied by the ask prices with respect to maturity, is your traditional upward sloping yield curve. At the time that this analysis was done, the base curve rates were very, very low. And then if we do this with respect to effective duration, if you'll notice, it levels out. That this is fairly steeply upward sloping, but if you do it with duration, you get a much more linear relationship. And typically analysis is more effective if you do it with effective duration. We can estimate the relative bond error in two ways. We could just fit the double B curve itself, or we could fit the base curve and the spread and layer it up. There's pros and cons with both of these approaches, and just context will drive which one is more important. At times, you may want a very clear development of the time series behavior of spreads. Other times, you're just focused on the double B rate. And so, again, modeling this with effective duration, the longer the maturity, the lower the marginal increase in effective duration. And so, effective convexity is with respect to effective duration. We have this traditional upward sloping convex relationship. Level duration and maturity, if you'll notice that the effective duration, the all-in level, base curve level, and spread curve level, all these things reside at about the same location. They're measuring the same thing, a 1 basis point change in either the all-in level, the base curve level, or the spread curve level. They have roughly the same effect. With regard to slope duration, that they are different. And depending on whether or not I'm modeling the spread curve, the base curve, or the all-in slope, you get different results. In slope duration, if you'll notice, the magnitude is much smaller. Curvature, again, the magnitudes are smaller, and we do get differences in the all-in curve, the base curve, and the spread curve. The all-in curvature 1 duration rises steeply and then plateaus at about 1.5. The base curve duration has the same pattern, but plateaus much higher, and you can see the different results here. Level convexity with maturity, again, the 4 different approaches: effective convexity, the all-in level, base curve level, and spread curve level. They're very, very close together. They're measuring the similar aspects of this particular bond. The slope convexity has the same patterns as previously seen, and again, the degree to which you need these different convexities depends on context. Curvature, the same idea. You get different results depending on whether I'm measuring the all-in, the base curve, or the spread curve. Cross convexities are actually relatively minor effects and can be safely ignored in most contexts. The horizon holding period return with respect to maturity. For me, this is a very important concept to understand. How much will the bond portfolio change just with the mere passage of time if nothing changes in the spread or the base curve? Some of the quantitative finance material, again, this is going to follow very closely Module 7.2. We'll be decomposing various static risk measures into component pieces. The spreads using the LSC model is going to follow the same procedure as before. What we'll have is the base curve rate based on the LSC model, and then the spread curve based on the LSC model, and from which we can derive the discount factors. The bond spread holding period return, we'll simply look at the effect of the change in spread once we adjust for the horizon effect and the base curve. And so the base rate estimation, as before, follows the same procedure as Module 7.2. The spread estimation approach, if you'll notice, is nearly identical. The only difference is we're fitting the spread as opposed to the base curve or the double B curve. And so with that decomposition, we can now take the unknown component of the holding period return, break it down in a whole series of return contributions, and these return contributions can be broken down in level, slope, and curvature component pieces. I know this looks like an enormous amount of material, but again, just zero out any components that are not required in your particular task, and you can focus on what is most important. And often, if you're doing asset liability management, where by design the durations are set to 0, where the asset duration is set equal to the liability duration, now what you have left is solely the slope-related effects and curvature-related effects, and that's where this becomes very important. The return compositions for spreads follow the same sort of pattern as the base curve. The factor durations and convexities can be found in the same way as previously. The only difference is we're looking at spreads as opposed to the base curve. There's R code that supports this particular analysis and can be either focused on the double B curve or the spread curve. And there's a whole host of different kinds of calculations that are done provided in the R code itself. So in summary, this is a module that's very similar to 7.2. The only difference is we're going to model the spread in order to get a richer understanding of the behavior of corporate bonds. We're going to model those spreads as an additional LSC model, and we developed the static risk measures related to spreads and covered a host of graphs. I'm not going to go through the R code in this particular module as it's very similar to 7.2, and there's some examples given of a particular double B bond and how this analysis is done. And so this concludes the bond section of the static risk measures. In the next module, we'll take a deep dive into understanding static risk measures with respect to stocks.